Hello everyone and welcome to this special edition of the 88 MPH Community Call. Today's call is going to be split in two as we have two very special guests with us. The first half of the call we have the pleasure of hosting AngleProtocol, and the second half will be with InsurAce. My name is Whipper and I'm a crypto enthusiast and a community volunteer at 88 MPH. Today's call is going to be jam-packed with valuable information, so make sure to stay tuned all the way to the end. Before we get started with the call, I'd like to remind everyone here on stage to please keep their mics muted unless they're speaking. If you have any questions from the audience or comments during the call, please feel free to raise your hand so we can bring you up on stage. For the sake of getting more community engagement during these calls, we've changed the format of these calls to an open-style discussion, so feel free to jump in with your questions or comments at any time. Simply just raise your hand to get our attention. As with tradition here at 88 MPH, we will be closing the call with a $100 raffle giveaway in the form of 1 MPH, as well as minting POAPs for those who join the call. On the agenda today, we'll be discussing over-collateralized stablecoins, insurance within the DeFi space, the recent Cream hack, the upcoming launch of 88 MPH's V3 coverage on InsurAce with a 50% discount on premium, news and updates from all parties here, followed by our raffle. So with that, I'd like to open it up with Pablo from Angle. Could you please give us a brief introduction into who you are, how you got into the crypto space, and what is AngleProtocol?
Yes, sure. Thanks for inviting me, Whipper. It's a pleasure to be here and get to know the 88 MPH community. So my name is Pablo, based in France. I'm pretty new to DeFi. When you speak to people in the ecosystem, they all tell you, look, I've done the Ethereum pre-sale. It's absolutely not my case. I was a student at Stanford University, started playing around with DeFi in 2020. I was having fun, with Compound, getting yield on my stable coins. And I realized at this point that since I was also in France at that time, studying remotely, I was subject to a change risk with my USD stablecoin. Because the USD in 2020 lost 10% of its power with respect to the euro. So I thought, look, we need to create a euro stablecoin. I came to see some Stanford friends, and I tell them, look, do you want to work on this with me? And that's how we started the AngleProtocol. The AngleProtocol started with the idea that we wanted to make decentralized finance more inclusive, to be able to propose money Legos, financial assets on-chain, pegged to other elements than the USD. The question we had was, how do we make such stablecoins? There is obviously the centralized way of making stablecoins, but we thought that for a regulatory perspective, but also for a technical perspective, it was easier to use the decentralized way, so build a stablecoin protocol like Maker's DAI to make the stablecoins we wanted to make. After spending some time to study everything that was done in the space, we ended up with our own unique design to make stablecoins. And we are going to launch our first Euro stablecoin in 1 week on the 3rd of November on the Ethereum mainnet. But I could go later in the details in this call about the intricacies of AngleProtocol.
For sure, Pablo, absolutely. We're going to dive deep into it. I know that our second half is dedicated to InsurAce, but since we've got Dan with us, maybe you just want to give a quick intro into who you are and what InsurAce is, and then we'll focus on the first segment on Angle, and then we'll bring it back to you, but just to have it a little bit more interactive.
Yeah, no worries. So I'm Dan Thompson. I'm the Director of Marketing and Business Development for InsurAce.io. It's a DeFi insurance protocol deployed on Ethereum, Network, Binance Smart Chain, Polygon, and Avalanche. We cover 8 different protocols across 9 different ecosystems, essentially just protecting your assets. I mean, there's been some quite high-profile exploits in recent weeks, recent months, and we're there to mitigate that risk. A lot of protocols will go and get audits and bug bounties, but that doesn't always mean that the user's funds are completely protected. The only way to guarantee, you're covered in the eventuality of a hacker stealing your money from a DeFi protocol is through insurance. So we're here to explore a bit of that today.
Thanks for that so much, Dan. Back to you, Pablo. So, okay, for those those who have been in the space for quite some time, it's quite obvious why we need crypto-native stablecoins. I know you touched upon this earlier in your intro, but take us back to the beginning. Like, what was the motivation behind the start of Angle?
The motivation was that crypto is great. Crypto, the reason why I like it is that it's permissionless, but most of all, it's non-censorable. When you have crypto in your wallet, no one can ever tell you, look, I'm going to prevent you from spending those bitcoins. I'm going to prevent you from spending those USDT. And I thought that without stable coins pegged to other elements than dollar, we wouldn't be able to completely fulfill the vision of crypto. I have one of my friends, he's from Lebanon, and the thing that is happening in Lebanon is that banks and the state, they literally prevent people in the country from spending more than $100 a day. They cannot access the money they have earned, the money in their bank accounts, and cannot spend it the way they want. And by building stablecoins, and that's the reason why I started Angle, I thought that we needed stablecoins to give access to unbanked people, to give access to finance to unbanked people in underbanked country, but also to give the opportunities to people who are in countries where they cannot have a full control over the ownership of their assets to get stablecoins pegged to their home currencies. And so that's also one of the main motivations behind Angle. The first one, and it's a very practical and technical one, is that in DeFi, there is no euro stablecoin, and if you just want to get yield on euro, if you want to get yield in DeFi, you are exposed to the change risk euro-dollar. But that's maybe a better perspective to give that we want to build stablecoins for everyone, and that's the goal of Angle, to make DeFi more inclusive.
I love that, and I really hope that you guys are successful in your mission, because everything that you guys are trying to achieve here is definitely in line with the ethos of the entire crypto space. But why Angle though? You guys obviously must have some like advantages over, I want to call some competitors who are trying to achieve something similar. Maybe you could sort of pinpoint some unique features about Angle that sort of sets you guys apart, that will make you guys successful.
Yeah, sure. Great question. So to make stablecoins, there are two ways. Either you make centralized stablecoins, so you are a company like Ether, like Circle with USDC, and you say that whenever you give me one USD, I'm issuing you on-chain one stable dollar. The thing is that it does not generalize well to multiple assets. If you want to build a system that supports a Euro stablecoin, a Korean one stablecoin, a CHF stablecoin, you cannot do this. And so that's the main advantage first of the protocol over centralized solutions, is that we can make anything we want. We don't have to keep assets in custody. We are also not exposed to the negative interest rates in the Eurozone. And that's the main reason for which there haven't been any big Euro stablecoins so far. It's super hard to build a viable business model around the Euro stablecoins, because there are negative interest rates in the Eurozone. So if you have $100, 100 euros in the bank, at the end of the year, you end up with 99.9, meaning you get under collateralized. So that brings us to the second category of stablecoins, how Angle differs from them. So the second category is decentralized stablecoins. What decentralized stablecoin protocol try to do is that, maybe decentralized stablecoin protocols, they are backed by a collateral. They are backed by cryptocurrencies that are volatile. And what they all try to do, they try to take something that is volatile in collateral, like ETH, like wrap Bitcoin, and make something that is stable out of it. That's what everyone does.
Can I stop you real quick? This is so super interesting. For everyone who's listening in the audience, you guys are probably more familiar with, like, let's just say a maker's model with regards to, DAI. And what Pablo was talking about is just putting up ETH or wrap BTC, and now you have a whole slew of different types of assets that you can use as collateral. Sorry to cut you in. I just wanted to add that piece in there.
Sure. And don't hesitate if you feel like you have a more valuable info to bring in. So to go back to the example of Maker, what they try to do to work as a system with volatile collateral to make stablecoins is that they fragment this volatility risk. In Maker, to issue stablecoins, you need to lock collateral in what we call a vote, and then when you have done that, you are allowed to issue some stablecoins. But the thing is, all collateral are separated from each other. I have my vote, you have your vote, and if the value of the collateral in my vote starts to be too low, then I can get liquidated. Fragmentation of the collateral and of the volatility risk, that's the first way. The other way to absorb, I'll go back to Maker afterwards, but the other way to absorb the volatility risk of the collateral is what Fay or Frax model do. They have a secondary volatility token. They rely on a governance token that is used to sort of counter the price variations of the collateral backing the stablecoin. So if the ETH price goes down, what these protocols try to do, I'm just like summing up, each protocol has its own specification, but they fall in the same broad category. What they do is that they issue governance tokens to enable to bring the stablecoin back to pay. So really simplifying here, not going into all the details. That's also another model. What Angle tries to do, and then I'll explain how it improves over other models, is that we have a system that is fully capital efficient. That is not the case with Maker. With Maker, to get one of stablecoin, you need at least 1.5 of collateral. In the case of Angle, if you want to get one of stablecoin, you need to break one of collateral. It's just like a swap. You bring us one ETH, we look at the price of the oracle, like one ETH for 3,000 euros, and we give you 3,000 stablecoins. And with your 3,000 stable euros, you can redeem the collateral you want at the oracle value. And the way we are able to do that and to sustain this convertibility at all times is that to absorb the volatility risk of the ETH we have in reserves, we just sell this volatility. We see the Angle protocol as a marketplace between people who want to have stability and people who want to have volatility. And the people who have volatility, who want volatility, they get the volatility of the collateral of people who want stability. So I know it's pretty abstract at this point, but that's one feature to remember. With Angle, we are a stablecoin that's super capital efficient to issue and burn, just like a swap. And we are a protocol that offers perpetual futures. So you want to get leverage with Angle, you want to get a long position, say you want to get a 2x leverage on ETH, you just have to come to the protocol, say, look, you have one ETH in reserves that has been used by someone wanting stablecoin. I'm going to bring you some collateral, we call that the margin, and I'm going to cover the volatility of this ETH you have in reserves. And so these people in Angle, they have the right to the capital gain they would have made if they had owned the ETH from the protocol they were insuring. So also technical, but that's how it works. Angle is a marketplace between people who want stability and people who want volatility. We are a derivatives-backed protocol and also over-collateralized. Another cool feature of the protocol, is that we have an insurance fund. Because this system, the system I've described to you, we're not the only ones to implement that. On Solana, there is a protocol called a UXD protocol. There are also other protocols like Pika Finance, like Lien protocols, who are going to launch very soon, who are based on this idea of matching long with stable, like in a perpetual swap exchange. The thing in our case is that we have an insurance fund, and we accept the fact that sometimes the protocol may not be fully hedged by people having long perpetual positions. Also technical, I'm really sorry for this complexity, but that's what it takes to understand in depth the protocol. The insurance fund is made by people just lending money to the protocol. And lend money to Angle, so that's the third cool feature. We have stablecoins, we have perpetual futures, and we have like liquidity farming, yield farming. And these people who lend money to the protocol, what we can offer them is like the transaction fees of people who mint and burn stablecoins. But also, like Angle is a stablecoin protocol, but it can also be seen as a yield. We have forked some yield strategies to get yield on our collateral. The first strategies do not involve 88 and PH, maybe at some point, I hope so. But we could have our first strategies consist in lending to compound and Aave. So we are getting yield on the protocol, on the protocol's reserves, but this yield on the protocol's reserves, we're just giving it to our liquidity providers who lent money to be part of the insurance fund. This means that we can guarantee to our liquidity providers a higher yield than what they would get if they were doing by themselves the same strategy, involving lending to compound and Aave. So to sum it up, and then I'll stop my long explanation. And sorry if I lost some of you in the meantime. Angle is a stablecoin protocol, super capital efficient to issue stablecoins compared with Maker. This means that the protocol is fully stable. With Angle, if you want to get perpetual futures, if you want to be long, then it's a no-brainer. Like you should go to Angle because it's cheaper than in other places. You don't have to pay funding rates because it's beneficial to the protocol. Very small fees. So if you want to get 2x leverage on your ETH, you should go to Angle if you are here for the long term. And if you want to get yield, then Angle can guarantee a higher yield than what you could get using Yearn, with I think a reward risk ratio that is way higher than what you can find in other places in DeFi. So I've explained the protocol, tried to explain how Angle stands out from other protocols. One thing I want to add is making stablecoins is hard. You need to be able to absorb this volatility risk of the collateral. That's the common points of all stablecoin protocols. That's why some stablecoins have failed. We have built a system that we try to make where we try to put agents together in a mutually beneficial way, and we have all the layers of security other stablecoin protocols have. So quite a complex design, but we feel it's very promising.
Wow, that was awesome, Pablo. There was a lot to unpack there. I know that Steven has a question. He wants to jump in. Steven, go ahead, bud.
Can you guys hear me?
Yes, again.
Awesome. Thank you so much for all that. It sounds like you said, was there a lot to unpack. I'll definitely need to dive into the documentation before we grasp everything you mentioned. You said something about one-to-one collateralization. I've seen a lot of these models recently pop up, and I really like that because, like you said, Maker is not the most capital efficient. I use Bitcoin and Ethereum vaults, and I have to keep my collateralization ratio at about 300% just for my own mental well-being. And I had a question for you about being able to, for example, let's say you put one Ethereum up, you have 4,000, you get 4,000 of your stablecoin. How do you actually protect, like what does the protocol do if, let's say, Ethereum dumps 20% tomorrow? How do you ensure solvency?
Thanks for the great question. The way we ensure ourselves is through the perpetual futures feature of the protocol. So you give us one ETH, getting 4,000 stablecoins. Now the protocol has one ETH in reserves. And so what it does is that it tries to incentivize people to come in and take the volatility of this ETH. So these people are called the hedging agents. So these hedging agents, what they do in the Angle protocol, they bring some collateral and they say, look, I'm getting exposed to this ETH. So now if the price of ETH increases, doubles from 4,000 to 8,000 euros, then this person has the right to the capital gain she would have made if she had owned the ETH. So a 4,000 euro capital gain, meaning at current ETH price, it's 0.5 ETH. But if the price of ETH decreases by 20%, well, we are going to take a portion of the collateral this person brought, since it's a leverage product, to cover for the losses of the ETH this person had in our position. So that's the way we are able to get balanced and to handle collateral price drops. Now I have two remarks for that. The first remark is that when you give us an ETH get 4,000 stablecoins, we don't have immediately someone coming in and we may not have someone immediately coming in and getting the perpetual future position. That's why our insurance fund is here for. That's why we have the third feature of the protocol, the one involving yield farming with a higher yield. So we call these people the standard liquidity providers. So the more collateral for users in the protocol, from users in the protocol, the more reward you get as a standard liquidity provider. So that's the first remark. And then I think I forgot. Sorry, I forgot my second remark. I'll tell you if I have some. Yeah, no, sorry, it came back again. So as you say, it's risky. And just to mention that when we're launching the protocol, we're just playing it super safe with USDC and DAI backing our Euro stablecoin. So we will not have the ETH part directly in the protocol. We want the protocol to play it safe, to get liquidity, to get some surplus, to be able to even handle the case where ETH price drops even better than what we would do if we were launching directly with this. But we could launch directly with this technique.
Thank you so much for that.
Pablo, so if I understand correctly, essentially when you lock up your collateral, you no longer have exposure to the upside or downside of your underlying collateral. Is that correct? That exposure has been sold off to someone else who wants that exposure, correct?
That's correct. When you give ETH to the protocol to get stablecoins, you no longer own the ETH you have given. And when you think about it, it's a way more natural way to get stablecoins. Like what Maker does, people issuing DAI are, I don't think people looking for stablecoins. There are people looking for leverage and people who are willing to go long. In the case of Angle, if you want to get stability, you get direct stability in just a swap. In the case of Maker, you lock ETH, you issue DAI. So either you use your DAI to do some yield farming, or you swap your DAI against ETH or against Bitcoin to get leverage. But the people issuing DAI are not stability seekers. They are most likely volatility seekers. And that's what's cool with Angle. You want stability, you get direct stability. You want volatility, in one transaction, you can get leverage with the multiple you want.
That's really interesting. That's a really super neat setup. But let me ask you this though, Pablo. What would someone do in the event that they want to still be long ETH, but they want to borrow against it? Because it sounds like with Angle, when you're using your collateral, you're essentially selling your ETH for stablecoins. What would someone do if they wanted to stay long, but they just wanted to borrow against their collateral?
So in this case, Angle is not a lending protocol like Maker is. And so I always put Maker in the same category as a compound and Aave. It's a borrowing protocol. It's not the case with Angle. If you want to be long on your ETH while still having stablecoins, what you could do is open like a 2x leverage position on your let's say you have 1 ETH, you put 0.5 ETH and open a 2x leverage position, allowing you to get exposed to the volatility of 1 ETH and use the other 0.5 ETH to issue stablecoins. And this allows you to replicate what you do with Maker when you borrow stablecoins against your ETH in reserves.
Yeah, that's really true. That's great. And I think if I heard you correctly, you mentioned that there's no funding rates, and I'm gonna assume there's no liquidations either, or did I go too far there?
So there is no funding rate because it's beneficial to the protocol to have hedging agents, people opening long positions. That's what makes the protocol work. There are some dynamic fees when you enter the protocol and when you go when you close a position. If you close a position in a moment in which we are having a hard time insuring all the collateral from the protocol from users who minted stablecoin, then we will increase the close fees. So dynamic fees, which sort of replicate the funding rate, but regardless of how long you stay, you can stay 2 years within Angle. You just pay fees at the moment you enter, you open your position, and at the moment you close your position. So that's for the first part of your question. About the liquidations, there are going to be liquidations within Angle. Like in any leverage product, if the margin, your position, the value of your position falls below the margin requirement, so we have a maintenance margin, like in all perpetual exchange, you can get liquidated.
That's awesome. That sounds great. So, but explain to me, why isn't there a funding rate though?
Because like in perpetual swap exchanges, what they try to do, they try to balance at all times shorts with long. And in some moments, shorts, there may be more shorts than longs, and at some points, more longs than shorts. And the funding rate is used to keep the balance between shorts and longs at all times. In the case of Angle, we don't have shorts, but we have stable. And the market is always imbalanced because the protocol prevents people from opening positions if we don't have any collateral to insure. So let's say like there is nothing in the protocol, we can't allow you to open a 10x leverage position on 100 ETH, you know. We need to have people minting stablecoins before allowing you to open positions. So we are the same as perpetual, like as other perpetual swap exchanges. The thing is, there are always more shorts, stable in our case, than long. And so the incentive is always one-sided. We always need to pay long or to take small fees on long for them to come in. And we don't need to take funding rates for them. I don't know if that answers your question.
Yeah, that's perfect. I'm gonna open it up here. If anyone else has, we are running a little bit soon. We're gonna be switching gears to InsurAce here. But if anyone has any questions or comments, please feel free to raise your hand. I know that there's a lot to unpack. This project sounds super, super cool. So yeah, just feel free to jump in, guys.
Thank you, Whipper. I had a question for you. Sort of a very broad question, but what is your long-term goal with the protocol? Where do you see yourself in 5 years, 10 years? And the reason I ask that is this structure seems very well set up to handle a variety of market conditions. As you were explaining that, it made sense that this could survive a bear market. This could survive -80, -90% hypothetically. Where do you see yourself in the big scheme of this space?
It's very hard to predict. I wish I knew after mainnet launch. What I'd like the protocol to become is really the way for decentralized finance to be more inclusive. So I'd like to have the Angle protocol be fully decentralized first, and not have a team of core contributors that does the majority of the work. But that's the same for all protocols, I guess. And then I wish the protocol has a lot of stablecoins with a lot of liquidity in all its stablecoins. So I want Angle stablecoins to be integrated in DeFi, to have a lot of liquidity, and also to be integrated in traditional finance, to have people in their bank accounts, not in their bank accounts because it's never going to happen, and banks will never let that happen, but to have people in their real life using Angle stablecoins to pay in some platforms. That would be, I think, the big goal and the dream for the Angle protocol.
Thank you so much. I know that's a very, very open-ended, difficult question, but I always like to hear that.
And maybe one thing, and I'm sorry, I've talked mostly about Forex stablecoin, but the Angle protocol can support basically any stablecoin. So I'd really love to have a stablecoin that's not pegged to a currency, but to an asset that does not inflate, like a real reserve currency. And that would be an achievement for Angle to do.
That's awesome. I'm scanning the audience real quick. It doesn't look like we have any questions. I know that I have several for myself, but we want to give respect to InsurAce here. We're just going to switch gears here, and if at the end of the call we have some more time, we'll definitely come back to you with regards to your questions. Dan, it's a pleasure to have you with us. Once again, apologies about the mix-up yesterday. Thanks for coming on the show. So, it's no surprise that insurance is probably one of the most important pieces to the DeFi puzzle. How can we gain more awareness, and how can we drive the costs of insurance down so that more users will add premiums to their yield farming strategies?
Yeah, it's an interesting question. Raising awareness is always tough, especially for projects in this space. People seem to just throw money at things, so there's a lot of noise around the wrong projects. So when the right projects come along, I think it's tough to sort of be that without shilling yourself too much in the wrong way. I think the temptation is always there, and obviously, my job is exactly that. I get approached by different publications, different individuals and influencers every single day asking for fortunes, what I consider fortunes, to promote the project without really understanding it. And we don't want that. We're building something legitimate for the future, but at the same time, people are getting hacked out. So we do need to raise the awareness quickly. And the hacks again, the hacks are happening. But we don't want to use that as a heavy sort of incentive. We don't want to be fear-mongering. We don't want to be the people saying, oh, there's hacks happening, protect your assets. It's going to be you next. We don't want to be those guys. So we raise awareness in the right ways. These sort of calls help. Getting involved with our partners and communities is always a great way of increasing awareness and just answering the right questions. I mean, if you're talking about the costs, I think the perception of cost with insurance in DeFi is that, yes, you might lose a couple of percentage points annually, but when you break it down, really, I mean, especially with protocols, especially like 88 MPH and other DeFi 2.0 protocols that are really emerging now, you're looking at a very small percentage relative to your potential returns. You're looking maybe 2.5% a year, which is roughly about 0.2% a month, against gains of 20, 30, 40% for something that is just something so simple, just to add in as a calculation. And all the sort of big investors and smart investors do this just to make sure that they're covered. And there's no reason that smaller investors, who are, ironically, it's the smaller investors and the day-to-day retail investors who, like myself, arguably you guys, that are the ones who should be, following the advice, because the amount we have invested, relatively speaking, for ourselves, is a larger chunk. The largest might be more diversified; they might have more money. So it's a sensible decision to do. It's just, obviously, people in DeFi and crypto don't necessarily like talking about costs. All they want to talk about is gains, and that's why we've seen a big migration over from Ethereum to other chains because of gas fees, and that's why we were multi-chain ourselves to mitigate those costs for our users. But at the same time, it really is a case of it should be an acceptable calculation. Say you've got assets staked in ATMPH, you've got 100k locked in there, and then you can insure that for sorry, Richard, you can insure that for a month for about $200, right? It's $200 to mitigate it's just one of those things it's already relatively affordable considering the risk that's out there. It's technically unregulated space, and when you're already getting quite high returns, to have that sort of just peace of mind that it's there, even on the big protocols. I'm rambling now. Even on the big protocols, and even there's obviously a very, very good example yesterday on Cream Finance. Been around for a while, lots of very popular protocol, and we did a nice little breakdown today on our Twitter if anyone wants to check that out. But even on great projects, I really shouldn't keep going on about it, but I do. But a great example that I always use is Impossible Finance. These guys basically, built Binance Labs. They basically built Binance, the part of the team that built the Binance Smart Chain, and the sort of ecosystem for all of the new sort of Binance projects to come out. They separated out, core team of 4 of them, had 4 different audits, and great project, great team, great backers, and even they got hacked. It happens to anyone. You have no idea who's going to be next, who the hacker's going to find something for. It could be anyone, and that's the reality of it. So all we do is we mitigate that risk, and we offer insurance to sort of cover it. And relatively speaking, the cost is relative. The returns are significantly higher. So yes, the costs are slightly higher than what you look for in a traditional insurance option. However, relative to the gains, it's still a relatively small amount to protect your assets, and to help with that as well, we've got our referral program that knocks a further 5% off, or 10% off if you're smart enough to figure out a way of referring yourself. A little bit of inside information there. And also, we're cheaper than our competitors. We've got a portfolio method that helps reduce the cost by insuring all your bags at once. We're always looking at bringing down the premiums and working with our partners, which is why we've got a fantastic offer on 88 MPH v3 right now for 50% off for the next 2 months until nice little Christmas offer come early.
That's awesome, Dan. Thanks for unpacking all of that for us. You mentioned that you're multi-chain. I'm just curious, is it possible, or would it ever be possible to, let's just say, take out insurance on Matic for an ETH position that you have in order to reduce overall startup or gas costs, or do you have to purchase the insurance on the actual chain where your funds are being put to work?
No, so we've been very good about this. We do allow you to purchase cross-train to avoid costs if you want to. It's preferable to be on the same chain because it makes the claims process much simpler. Obviously, same wallet, same address, same chain makes the sort of verification of any claims much simpler. But we've been one of the best sort of multi-chain builders here in terms of we built our own bridges across, and you can purchase coverage for different chains. It just depends on the available capacity that we can offer from the network you're currently on, or the network you're choosing to insure. So yes, you can do cross-chain coverage to reduce gap fees.
And I have another question for you. In the event of an actual claim, let's say you had a fixed interest rate position and you had $100,000 at the end of the day, you have $120,000. Does that claim cover just the principal, or does it cover the principal plus interest?
So unfortunately, at the moment, it is the principal. So I mean, it's actually up to you guys. It's actually up to the user themselves to go to our app and select the level of coverage they want and the time period they want to insure it for. So in the future, with our API and direct integration, we will be able to essentially track the total value of an asset locked into a particular protocol, including any interest. But at the moment, it's up to the individual to manage that themselves. So if you had a bumper month and you had in that 100K you went in and you actually only covered say 50K, and then after a few days you saw the price went up to doubled somehow. So you've now got 200K locked in that, and you thought, okay, actually I need to update this. You can go in and buy 50K more, or 150K more if you wanted to cover the whole thing. In the future, very, very soon, we'll be releasing our cover modification and cancellation option as well, which will be an on-chain, basically editable covers on-chain. So that's coming up soon. But at the moment, it is up to the user to decide how much coverage they want and for how long.
And, at the end of the day, it's kind of getting easier. If an exploit happens in some protocol, I'm sure the user's not going to care too much about that interest. They're going to want their principal back more than anything. But I appreciate you answering the question.
Yeah, that's exactly right. They're going to, most people would just want to cover their principal. They know the game, and they know the risk, and they're covering that initial risk. And the interest is golden. But at the end of the day, they just want to make sure that their initial capital is safe.
Dan, do you think that maybe some other DeFi users are afraid to purchase insurance because maybe they feel that, maybe, like for example, what are the risks when you take out insurance? Like, how can one be certain that if there is an exploit, or if there is something, that the governance or the token holders for the insurance protocol will vote in favor properly, as opposed to I've heard of people taking out insurance before and not being covered, so to speak. Like, what do you think that there's a fear? Is that why we're not seeing more DeFi users take out insurance?
Yeah, I mean that's maybe one smaller element. I think that there's a part of it that is that with our governance model though, it's a bit better. Obviously, there's no guarantees in the background. There's no government or company or regulation. But at the same time, we limit ourselves on our capacity. So we've always got the available funds on even a black swan event of say 10 different protocols getting hacked to the maximum capacity. So we've got more than enough capital in reserve for a monster sort of claim event across multiple chains, multiple protocols. So there's never a question of capital available to pay out. The question of whether the governance model would do that. So our model is that on the event of a claim, again, it's all on chain, so it's pretty hard to say something didn't really happen, but it goes to our sort of advisory team, who are an insurance expert, a blockchain expert, legal expert, and financial expert. They then produce a report which goes to our governance. It's a form of a DAO. It's not a DAO, but it's close. So our insured token holders would then, anyone when they stake with us, they can then become voters. No voter has more than 5% voting power, no matter how much they stake in. So we mitigate all the risks, and this is all written down in a white paper, and it's all on chain again. So it's all it's all easy to follow. I say easy to follow. It's all there, but it is possible to prove in the event of a claim. Then on the voting, only the winning side would get the rewards, and so it's you are talking about DeFi community. We don't take on any protocols that we think could be a potential conflict of interest, which is why we don't reinsure any other insurance protocols, because obviously there's a slight community interest to we shouldn't say it, but there is a slight community interest to vote against it. In other protocols, no. I mean, the capital's there is what we're there for, and actually, ironically, we actually could claims being paid out would actually be good for our token and our protocol, and for our sort of use case as a provable thing. We talk about it a lot actually, and it's the reason we have limited capacity on each protocol, so that we don't end up wiping ourselves out with one particular protocol. We could easily sell out over coverage on many different protocols. We actively avoid doing that to avoid that particular risk. So we're basically mitigating the risk that happens. We're not
there to say if you've purchased insurance for that exact reason in DeFi, it should be faster, it should be more efficient, that you're going to get shot down at the event of that. And then even following a claim and the process, we have an appeals process just in case it doesn't, someone really thinks that it didn't go the right way.
Thanks for that, Dan. I guess what I was trying to ask, and sometimes, do you guys consider an exploit like any theft of funds, or an exploit is an issue with the code itself? Because I think there are some very creative people out there who are able to use flash loans that it may not necessarily be an issue or bug with the code, but someone was able to somehow manipulate something with a flash loan in an arbitrage situation where they're able to steal funds. Would something like that be covered?
Okay, so flash loans obviously a hot topic, or they were at least a month or two ago. Flash loans, no, because it is using the app, using the protocol in a way that's available to all. But bugs native into the code and direct attacks and exploits, yes. Flash loans are a slight grey area. We are working on a flash loan attack sort of coverage wording that can cover it. So in some instances it is, some it's not. It depends on the way it's done, really. So there have been a few examples previously. We wrote a few posts about it that we would cover versus ones that we wouldn't, and it's an annoying grey area. But flash loans are really the only sort of grey area when it comes to this that we have at this point.
And would you say that most exploits have been bug related to code, or is it like a 50-50 split between people using flash loans and exploiting through some very clever loophole?
I think it's mostly exploits and loopholes. The bug element doesn't, because for the bug element, you're looking at protocols that we've done a risk assessment on, have had audits already, and with great teams, great reputations, active communities. So even to pass our risk assessment, to actually have on our sort of books already, it's hard to sort of and then even with bug bounties, things like that, it's hard sort of, the bugs don't really come around too often. They do happen, but they don't come around too often. They tend to happen on a lot of the smaller early stage protocols, but those, even though they have value to the end user, they are not quite on the sort of wider radar. So they don't get publicized as much as the sort of big exploits. That said, we are actually working also. We've got so many products coming out. Our team, one of the fastest builders out there. Honestly, they bring out stuff faster than I can make announcements for. But we are working on another product, which is actually a sort of an unlisted protocol insurance. So any protocol we haven't already listed on our app, we're working on a sort of essentially an algorithm that we can produce an insurance product for, so that you found a new DeFi project, it's about 3 days old, and you wanted to insure it, you could come to us and say, you could say, I want to insure X protocol, my assets on X protocol. It might cost slightly more and slightly higher in the premium, but we'll be able to offer that soon. So that will help for the sort of bug element a bit more.
Yeah, it's true. You guys are absolutely killing it. I remember the last time InsurAce was on our community call, but you guys are doing an amazing job. I mean, like the speed at which you guys are shipping stuff is really amazing. So keep up the good work on that front for sure. I do want to talk a little bit about the Cream hack, because it's been everybody's been talking about it all week. What are your thoughts on what happened there? And maybe you can explain to the audience, was this an exploit using Flash Loan? Was there an issue with their code? Was there any insurance coverage for Cream? Maybe you could talk a little bit about it and fill everyone in on what happened and what the situation's looking like on the ground.
Yeah, so I mean, I do the business development marketing. My technical knowledge on the actual way the hack got in is not up to scratch exactly. The exploit happened. I mean, Cream themselves admitted $130 million worth of tokens taken from the Ethereum network pool that they have, which is obviously substantial. I mean, I read a report yesterday of someone saying it was $1 billion, so I think 130 million is a slight silver lining there. Even though it's still not great. So Cream's an interesting one. We actually did a risk assessment on Cream, I think a month ago, and then we actually did another follow-up one when they got hacked recently. They had a smaller hack a week or so ago, and because of that, they didn't pass our risk assessment. But there's also another report that's saying that the hacker had actually bought a load of insurance with Nexus Mutual just before the exploit happened itself. So we didn't cover it because it didn't quite pass our risk assessment levels. And this just should form part of the due diligence anyone does in DeFi these days. If insurance protocols aren't willing to cover a particular protocol, the question should be why. We do our own risk assessment, which is akin to an audit. We're not regulated as an auditing firm, but the quality of the risk assessment we do is there. So the exploit happened. I believe it was a version of a flash loan. I think it was a bit more in depth than that. I think Cream covered themselves following a load of flash loan attacks a few months ago, but they managed to siphon off, like I said, 130 million in tokens over a couple of hours, and obviously a lot of people are frustrated. If it would have been an insurable event, had we covered them, it would have been something that users who had a stake there, who had lost funds, would be covered for. It was a direct exploit, malicious act, and it even though the methodology, again, like I said, was a bit of a grey area, it would have been something we definitely would have paid out for. And if it were to happen to any of our existing protocols, then it would be something that we would cover. It's always hard to say after the fact because obviously we weren't covering it at the time. But it's just, like I said, it's an interesting topic, and we did a nice sort of write up on it a little bit earlier today on our Twitter.
Guys, we have a couple of minutes left with InsurAce. If you have any questions, comments, please feel free to jump in or raise your hand. Dan, let me ask you something. Even for myself as a DeFi user, you mentioned that flash loans is sort of like a gray area. If the majority of exploits are happening with flash loans, how can we get more people to feel comfortable with insuring their positions in these gray areas? Because I guess maybe one of the concerns from a user is that, well, why would I go ahead and insure myself on this position if 50% of the attacks are flash loans and it's gray area. I don't know if it's going to be covered. Tell the give it. Maybe we need to have a better understanding of how things work so that we can get more awareness, so that people are covering their positions. But what would you say to someone that is concerned about that?
Yeah, I mean, flash loans don't really take up a vast majority of the percentage of attacks. It's there's such a vast array of potential attacks. It's just one option. The policy wording we have is fairly clear. It's not as complicated and as extensive as some traditional insurance companies may produce, because obviously they're dealing with events that are fairly subjective, whereas we're dealing with objective on-chain events, right? So obviously, you do due diligence into their own risk coverage and policies as well. Jump into our Telegram community. Our team are always there to offer. Our team are always connected. So even if it goes to our community managers, our team will answer quite deep questions, in a relatively short amount of time. If there's a specific question as to what something is covered, what's not covered, and we get great questions all the time to that effect. So that should help with the reassurance that the coverage will cover everything that the user would need. And it's one of those things, right? If an event happens where it's a flash loan attack or something that's slightly not covered, it's something very quick in the space for us to deal with. And as I said before, our team are very good, very quick builders. And as soon as we realize there's an issue, we do aim to fix it. So it hasn't been an issue so far. The policy wording is quite extensive, so people really are very well protected with us. There are a couple of exceptions in there, but it's all covered in the wording of the policies, and not hidden as well. That's the thing. It's not it's obscured, tucked away. There's a couple of exceptions that are highlighted very clearly. That should offer users some reassurance as to the protection we can offer, and just to make sure that they know that we're there for them. And if there is an issue, they know that it's going to affect us negatively if the common perception is that there is this should be covered by insurance services. And like I said, we have the capacity, so if that does occur, we can reevaluate and look at it and maybe change the wording and make it right by the users as we go along.
Can you
that's a great answer.
I was going to say, can you touch briefly on the revenue structure of InsurAce?
Yeah, sure. So as an early, we're still early stage. We've only been going for about 6 months. We've just crossed the I think 700K mark in terms of revenue, covering total coverage so far has been over 100 million. Revenues come through initially from partly premiums, from premiums really. So the way insurance works is it's a race, really. It's a race to get as many protocols across many chains as possible, to be as decentralized as possible, with as many premium sales coming in as we can. Following that, you have what's a minimum requirement. So we'll know how much capacity we need for each protocol and each chain. So we know how much capital we require for that. After a while, the main source of capital pools will be the premiums paid. Now, these premiums paid will begin to exceed that minimum capital requirement in a black swan event of, say, 5 protocols getting hacked in a week or a month. So the capital after a while will exceed that. The revenue model after that is to reinvest the excess capital into other protocols to generate additional capital, and that will be with our partners like ATA MPH, for example, where we can reinvest the available capital through an investment portal, which we can also then encourage some of our users and stakers to lock funds into our investment side, which will help generate even higher yields through higher staked funds.
Thanks for that, Dan. Guys in the audience, if you have any questions and you want to jump in, feel free. I'm going to pass the mic over to McFly. If you'd like to focus on any updates or news related to 88 MPH, now would be a great time to do so. And then if we have a little bit of extra time towards the end of the call, we can go back to Angle as well as InsurAce before we end things off with our raffle.
Yep, sure. Thanks, Weeper, and thanks, Dan. Thanks, Pato, for coming here. It was great to chat with you guys. Weeper, just to confirm, can you hear me well? I still have some network issue apparently.
Yeah, you're coming in perfect. Thank you.
Okay, awesome. So yeah, like we can talk about all of that for hours, like especially stablecoin in euro, Swiss franc, and stuff like that is really great. I'm pretty excited by what Angle will launch. So we will look forward and see how we can build some synergy together there. For sure, like we will be really interested to list some stable coins in euro on 88 MPH. So yeah, that would be top. And the big news for today with Dan is we have the 88 MPH V3 coverage already live since some hours. So if you go directly on 88mph.app/earn, you will see that there is a new link, a new call to action by insurance that will lead you directly to a Medium post where you will see a small line where you have a coupon code, and this coupon code will give you 50% discount on the premium for insuring your deposit on 88 MPH, basically insuring everything you do with 88 MPH. So it's not just deposit, it's the whole smart contract ecosystem. So that's really dope. The discount is there for 1 month, and you will end up paying 2% premium, if I said that correctly, Dan, right?
Yeah, that's right. Yeah.
So yeah, I think that's the cheapest insurance you can find right now for basically covering all your use cases with 88 MPH. So that's really cool. And thank you, Dan, for doing all of that. Really cool. Really appreciate it.
Yeah, my pleasure. Absolutely.
Yeah, so like just a question for you guys. Maybe it's like a dumb question. I'm wondering, I'm aware that some policies were already bought, but I don't see any decrease in the amount of maximum coverage, the maximum capacity of the pool doesn't decrease. So I was wondering all of that work, like if there is some decrease at some point, like according to how much people buy the coverage.
I think because it focused on a much larger scale, I think it doesn't show up immediately. Plus I think the time frames on the available coverage is slightly delayed. Just with a very we'll check it. I mean, it could just be a slight a data bug, but I think it does normally update itself.
Cool. So yeah, like the maximum capacity I think is 1.400 million, right? Like it's 360 ETH maximum, I think.
You've caught me out there. I'm having to check.
Okay. So yeah, it's just a start. After like we will see how things goes according to how much people buy the coverage. So yeah, if the amount of TVL into 88 MPH continue increasing, we will see probably more purchase of coverage there for sure.
Yeah, it's there's 343.2 ETH currently available. It says 1.4. I think we had it actually slightly higher to begin with, so I think someone's already been sold.
Cool. So yeah, that was really cool. We will see all of that will evolve in the following weeks. So yeah, going back to the news, like real quick, guys. we were working on a lot of different small iteration, small improvements regarding the front end. So you see, like probably every day or every 2 days, we are pushing new changes on our repo for the front end, for the user interface. We need to push new stuff for the stats to have like more granular data there. We also push some new like improvement regarding how we display the best fixed yield available for each asset. So it's live right now on the Earn page. You can have a better understanding what's the best yield, for example, for DAI on 88 MPH right now. We stopped displaying like every DAI pool available. Right now, we just display one with the best yield. But you have, of course, the option when you deposit to select another protocol. If you don't like Compound, for example, you can deposit with Aave or another protocol we are supporting, depending the chain where you are interacting with. So all of that were like based on user feedback. So don't hesitate to directly jump into the feedback channel if you have ideas or feedback. Like we take that really seriously, and we are like continuously iterating based on your feedback, guys. So it's really helpful. So continue doing that, please. And the other big things we were working on is bridging MPH with the different chain we are supporting. So Avalanche, Phantom, Polygon. So that thing is done. It's not yet deployed, but like basically the code base is there, and we will have a minter contract directly on those chains. But like the smart and more secure way of doing all this deployment is starting with one chain. So we'll have a bridge for one chain. We will have a MPH minter contract that use the same code as on mainnet, so it's already audited. On one chain too. So one bridge for one chain and one MPH minter contract for one chain too, just to be sure that nothing horribly wrong happens. So we will like proceed cautiously with that, and we will scale the operation regarding bridge and minter over the next days after that. So expect some news, big news for that in a few days. Basically, the UI is done. We just need to plug some stuff between the front end and the smart contract for the bridge. But yeah, like everything looked great. So yeah, that was the big things we were working on for the last 2 weeks. And after that, basically we'll focus on increasing the TVL, working with partners there for like deploying some strategy and stuff like that. So like there is a lot of things under the hood happening. But as you know, like we just announce things where it's ready. So yeah, just yeah, we keep building for you guys and for us, of course. So and improving everything. And I think that's it. With like I won't dive into like a lot of details. We will publish a change log listing all the different improvements we have done in the past 10 days. So probably I will do that tomorrow or Saturday.
Yeah, that's awesome, McFly. Thank you so much. And thank you to our special guests who've come out and shared all of this valuable information with us. We're going to head to the end of our call with our raffle segment. So I invite everyone in the audience to please head over to the general chat and put in a number between 1 and 30. Please only put your entry in once only. The person who gets it or closest to will win today's raffle of $100 worth of MPH. So I'm going to pause here for about 30 seconds while everyone has an opportunity to put in their lucky number, and we'll take it from there. Steven or McFly, if you guys want to message me the number in our private chat, that'd be awesome. Thank you, McFly. Steven, if you can help me scan for the winner, that'd be awesome. Guys, you have about 30 seconds left to put in your entries. Please go ahead and do so. While we're waiting for the entries, I just want to thank Pablo and Dan so much for coming on today. We really learned a lot. In the meantime, while we're waiting, please feel free, guys, to drop in our general chat some information where we can follow the progress of your projects to stay up to date. So feel free to either drop your Twitter handles, your Discord server, your Telegram, anything that will make it easy for us to follow the progress. And we thank you for coming on, and we want to wish you guys lots of success going forward. Okay, guys, it looks like the raffle is closed. We're gonna choose our winner here.
Looks like is it MF Jerky?
Yes. Steven.
Yes, can you hear me?
Yeah, can you hit him up with the tip CC bot? Because I'm completely out. I gave you everything I had.
Yes, I can do that in about 10 minutes.
Sure, no problem. Awesome. All right, guys, that's a wrap. Thank you guys so much for coming out and supporting your favorite project. We wish you guys a wonderful day and look forward to seeing you guys on the next call. Thanks, everyone.
Thank you.
Thanks, everyone, for coming.